let's not underestimate the importance of France. Here now, one of the weak links potentially is France, which is the other big AAA safe country. In the moment you remove that, also that supply of sovereign debt, given how much the ECB is already buying, you remove that supply of sovereign debt, the bond yields are really telling you what the demand for safety is.
Arguably, French bonds are telling me there's not much demand for safety at all. We're still negative 50 basis points on a 2-year. The market's been very well bid over the last couple of days. Bear in mind, yes, the prospect of a Le Pen victory has become increasingly likely compared to 6 months ago, but yet not very likely. We still trade at 1% on a 10-year. We're not pricing in euro disintegration, are we?
No. No, but I think at this stage, at least this early in the process, the right way to look at it is relative spreads. Because remember, just like Germany, France is also affected by incredible amount of buying by the part of the ECB and the incredible amount of duration demand that there is. So on a relative basis, that's really, so French to Germany spreads is really where to gauge the credit risk premium or sovereign risk premium being priced into French bonds.
I get how that can be the story of the sovereign market, but in the equity market, European equity funds saw $2 billion of inflows so far this year. It feels like every strategist that we have on says buy European stocks because they're so undervalued. JP Morgan says that the earnings potential could be as much as, they could return as much as 6%. Is that the right call, or is that underpricing risk?
I think, and I like the way you pose the question, because I actually think it is the right call for a couple of reasons. It is important to remember that the European equity market is one of the most globally diversified. Europe is one of the largest, is the largest open economic bloc in the world. The European stock market is the most pro-cyclical and exposed to global growth. So you're not necessarily exposed to too much domestic risk when you buy European stocks. And at the same time, you are also receiving a discount on cash flows from these incredibly low bond yields. So also, whether you're chasing potential for earnings growth, which I think is the right call at this stage, as well as multiple expansions because of low discount factors, you have room to run at this stage.
So we don't know what's going to happen yet in the French elections. We do know, within reason, I think, Jonathan, we know that there's going to be a Brexit, right? So how are the markets, within reason, I said, within reason, but how are the markets pricing that risk? Because that's a sure thing, although the consequences are not quite as sure.
I think it has taken a backseat for a while, because most of the immediate short-term impact has really has been positive due to the beneficial effects of currency depreciation. I do agree with you that Brexit will impact more certain sectors in the equity market, but it will probably be more detrimental to the British stock market rather than the European stock market more broadly, until we need to see how the European political risk compounds to it. I think for now, there's so many overlapping events with different deadlines to it. When a Brexit process still has this 2-year window, and Article 50 hasn't been triggered even yet. I think, again, the market will focus on what is more immediate now, what is more certain now, and I don't think from an investment standpoint it is the right strategy to be right too early. Being right too early equals being wrong. What I mean by that is there are political risks, Brexit or the European political calendar down the road, which can keep us busy for the next 2 years. But you don't position for those events at a moment where global growth is accelerating on a synchronized fashion. If you were to just look at the global growth picture, it has not looked this pretty in a really long time.